Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, welcome to our special podcast mini-series based on our just released India Market Outlook for the second half of 2025. My name is Ravi Singh. I'm the Chief Investment Strategist at Standard Chartered Bank India, and I'll be your host for this podcast. The first half of 2025 has been a rather interesting one, punctuated with multiple twists and turns in the plot. Global trade uncertainty, escalating geopolitical tensions drove volatility across asset classes. Bond yields whipsawed through the quarters on rising inflationary worries, while USD fell sharply on rising growth concerns in the US. Major equity benchmarks fell into bear market territory briefly, though they rebounded strongly in the second quarter, reaching fresh highs as sentiments improved. Now, to get a sense of what to expect from the markets in the second half of 2025 and the next 12 months, we have with us a special guest today, Mr. Amit Mamgain, Head of Managed Investment Products, Strategy and Wealth Seats at Standard Chartered Bank India. Hi Amit, welcome to India Money Insights.
Hi Ravi, happy to be here.
Well, we've just concluded a volatile first half of 2025. How do you see the rest of the year panning out?
Well, Ravi, indeed, it has been an interesting first half of the year. Overall, asset class performance has been strong, much similar to the periods of favorable risk environment. Indian equities delivered 9%, bond delivers 5%, and gold delivered a 26% return. I'm happy to say that this has been broadly in line with our bridging the gap strategy that we released at the start of the year. However, this masks the volatile journey we have seen at the lows of January and February, followed by a strong double-digit rebound in equities from April's low. Now, if you zoom out and look back, the first half of 2025 has been a textbook lesson in investing through volatility for our investors. We have three key lessons. First, market timing is difficult and costly. The sharp rebound in equities in Q2 means lower returns for investors selling in panic or sitting on sidelines. This is a common behavioral bias that investors should avoid, especially during periods of heightened volatility. Second, a diversified allocation can help tide through volatility. Domestic bonds gain on aggressive easing of monetary policy and liquidity conditions, while gold rally on safer haven demands amid rising trade volatility and policy uncertainty and escalating geopolitical tensions. Now, this highlights three facts: how peak to trough drawdowns are becoming shallower, second, recoveries are faster, and third, market cycles are becoming shorter and shorter. And finally, geopolitical conflicts tends to have a short-term impact. Markets have moved higher and crude prices retraced lower despite rising geopolitical tensions in Middle East, indicating its short-term impact. Very consistent with what we have observed in the past. Now, this could change if these tensions escalate into a broader regional conflict.
Interesting observations indeed. Now, coming back to my original question, what's the outlook for the second half of 2025 and the coming 12 months?
Ravi, we believe both economic and earnings growth is likely to revive in H2 of 2025. Easing financial conditions and the fiscal boost via income tax cuts is likely to lift consumption, supporting domestic demand and corporate earnings performance. In our view, though the worst for Indian assets may be behind us, investors still need to be very selective in risk taking.
Amit, you mentioned being selective in risk taking. Could you build on that a little and what it means for our investors?
Sure, Ravi. Let me elaborate. Now, our first large theme, Ravi, is being overweight on equities in our foundation allocations. A strong macro outlook, a likely revival in corporate earnings, and a weak dollar outlook are key factors supportive of risk asset performance over all the other traditional assets over the next 12 months. Now, within equities, we have made a change. We closed our preference for large cap equities and now prefer a diversified equity allocation as the risk reward turns more balanced. While large caps offer a better margin of safety. Historically, monetary policy easing and improving domestic growth has been very supportive of broader markets outperformance, specifically in the early phases. In our sector strategy, we favor domestic focused sectors and like a barbell approach. Overweight on cyclicals via firstly financials, given that they have a better market risk reward on both earnings and valuations, and secondly on consumer discretionary, given our view of a pickup in the domestic demand. We add a defensive overlay to this with an overweight on healthcare, given the sector's resilient earnings performance and lower sensitivity to growth risk. Now coming to fixed income, Ravi, we expect bond yields to decline modestly over a 12-month period. Front-loaded policy easing and improving banking system liquidity are offset by unattractive yield premium. As such, we remain neutral on bonds. We see steepening of domestic bonds yield curve and are overweight on medium maturity bonds and high quality or AAA rated corporate bonds, where we see a much better risk reward. Now, very importantly, we remain neutral on gold, Ravi. We see gold as a key portfolio diversifier and a hedge against market uncertainties. And finally, we remain underweight cash because we see increasing risk of reinvestment.
Thanks, Amit. We've discussed our macro and asset class views. What are some of the risks that investors should watch out for in the rest of 2025?
Ravi, it's a good point to bring up. As we see, external risks are still live, but the impact on India is likely to be contained. To call out, we see two key risks to positive macro views. Firstly, early July brings the end of Trump's 90-day tariff pause, and secondly, Middle East and Ukraine-Russia conflicts continue to simmer. We expect these risks to result in temporary volatility. Now, as per media reports, India appears to be in advanced stages of trade negotiations with the US. However, in absence of an outright deal, we do expect extensions to allow room for negotiations. But it would not be without a rhetoric. We see any spike in oil prices on geopolitical events to be temporary and expect oil prices to be capped primarily on excess global supply.
Thanks, Amit, for joining us on the podcast and giving us valuable insights on market outlook for the second half of 2025. This brings us to the end of the podcast. Do reach out to your relationship manager for a copy of our latest India Market Outlook. You could also find a copy of this on the SC Invest section on www.sc.com/in. Alternately, you can also find it on the Market Views on the Go page on our portal. Thanks very much.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.sc.com/in.